I'm sure many of you would know him, but it's my duty to introduce our guest. So please be seated. So he heads Aditya Birla Sun Life Mutual Fund. He's the CEO. He's donned multiple hats. He's been a celebrated fund manager. He's handled the fixed income portfolios and the equity portfolios. And his visionary leadership has actually handled billions of assets and then actually helped many people to realize their dreams. And then interestingly, he's donned multiple hats. He's been part of Amphi erstwhile, and then it contributed immensely, not just from an organization point of view, but I think overall industry's growth. Welcome again, sir. We have many questions to ask you and then learn from you. The first question, let's say I would like to ask you on behalf of the audience is, last 1.5 years or so, there's so many things which we really didn't factor in, right? I mean, we never thought probably a war could happen, right? We always thought a quick action might happen, but we saw Ukraine-Russia war. Other geopolitical risks, what we are seeing right now in Middle East and so on. Suddenly, markets have become very volatile. From a retail investor point of view, in times like this, how do we navigate? What kind of portfolio should I have? Should I go conservative or should I go aggressive? What should I do as a retail investor?
Yeah. See, I think retail investors, you have to divide them into age bracket. Okay. If you are the age of 25, 28, then question to ask yourself, you want to be conservative, you want to be aggressive, you want to be moderately conservative, and so on and so forth. When you have another 30 years for you to your work, your life is starting at, work life starts at 28. Your retirement is at 60. That means you have to work for another 30 years. Unless we all want to take actually at 45 years age retirement, right? I don't think it's going to happen. That means your 60 is going to be your retirement age. That means you have long years to go. Second, where most of the youngsters also don't consider, because I see in my own family also. They always take the initial salary actually is the salary is going to remain till the age of my 30, which is not going to be the case. Every year will get about 5% increase, 7% increase. Power of compounding, right? When your working age is for long, then you don't need to be conservative. You must take risk in equity. Question doesn't arise. Yeah. Because in the long run, the companies will grow at about 2 or 3% above the nominal GDP growth. That is more or less a given. Anybody for the money will leave aside some ups and downs. Some company will exist, some companies will die. All those will happen. But overall, from an economic point of view, it grows. Then people have to take the risk. But as the age progresses, then you must actually look at balancing your portfolio. If I'm at the age of 50, I have to be conservative, no doubt, because I have working life is only about another 10 years. Then after that, pension will come. So pension may not be sufficient to actually meet my retirement this thing also. There are all such things comes. Within the equity, there are schemes which provides a little bit of higher protection. I think if you take hybrid funds as a class, it has a good mix of equity, good mix of debt. Such schemes also today, mutual fund industries have been offering. So it would be suitable for, even for conservative investors. At the end of the day, what is the ultimate goal plan of every investor?
So today, everybody, when they start their journey into investing, you also would have come across this question very often that, I don't know where to start from. Yeah. Okay, I want to invest, but I don't know what to do. Which fund is better, what to do, and so on. Say somebody, if I'm in my early 20s, if I want to invest, say, about 10,000 rupees per month, what kind of funds I should start my investment journey with?
South Indian families, they always they know one thing, which is the doubling of your money. Yeah. Because the postal deposit in those days, it gives a double of your money. There is a formula which is right, 72 divided by the return is the one which will determine actually how many number of years will double your money. 72 divided by 10 means 7.2 years will double your money. 72 is divided by 10. If you increase it to 10, you increase it to 12, that many number of years will come down. I think where that can come in real world, it comes in equity. Therefore, anybody who starts the investment, he must, of course, go about putting money in equity. Again, as I mentioned, within the equity, you have a multiple categories there. The broad market, the large cap, you have a flexi cap, you have multi cap, you have a mid cap, you have small cap. But same way, companies also start small. They want to become bigger than the smaller companies, right? Yeah. Therefore, when the company is looking to go in the business, just imagine somebody is actually starting a small, say this year. And the next 25 years, you're going to build his business. You will also have equal aspiration that you will have to create wealth for the shareholders. Therefore, small and mid-cap companies gives you that kind of benefit. Therefore, as investors, at 10,000 rupees you want to put, Like small and mid-cap companies, if the money is for 30 years, money is for say 15 years, for 10 years. If your time period is long, then you must take the right approach. Sometimes what happens is we may not want to take risk.
Yeah.
If you also don't take the right risk, is the problem. Investing for such a long period, choosing these schemes which can deliver better return in the long term, should be the right mantra one should apply.
So you mean to say we could consider flexi cap, large cap,
Like flexi, no, more than large cap, if it is 30 year, you can go for flexi cap,
mid cap?
mid cap, small cap. They can, because he is investing for long term.
Long term.
Yeah.
How much allocation you think that similar age group should have towards gold? Should we invest in debt funds, if at all?
See, age group of 20-25, gold is not the right asset class. Gold you have to buy only to please your mother, sister, grandparents, then wife. But all these things only has got a storage value. Storage value. That doesn't give you, but of course it gives you, you have to also in the society when you go
factor,
around,
yeah,
you have to also show that I am also wearing nice gold chain, etc. Nowadays, covering necklace also, a lot of people do that nowadays. Therefore, gold, I am not saying you should not invest. You must invest in gold, not for youngsters. Youngsters, you just wear it only to show here and there, all the things, and to please the better of the family. That's the only thing you have to do.
Okay.
Whereas that money, if you put it in, say, equity, you never forget this is the power of compounding. And that comes only in the equity big time. Next comes is the fixed income. Then comes in the real estate. Then comes in the gold. Actually, gold comes in the pecking order if you take. It comes in the
towards the end.
Fourth, towards the end. Except you have the feeling of safety. You have this feeling of safety. Tomorrow you want to actually take a loan against that, just go to any shop and take a loan. But mutual fund can be withdrawn. No issues on that.
So now we looked at the category of funds to be looked at. Now, as an investor, mostly we look at returns while looking at the selection as a cycle, right? When we look at returns, it's very attractive, and then we tend to invest, and then we may not get the similar satisfaction once you've stayed invested. So what are some of the parameters would you suggest for an investor other than returns? What are the other things we could look at?
I think definitely the return is fluctuating. If I do very well today, I think there will be a period which will come, I am not doing very well. Some fund money is not doing very well today. The time will come where you will do exceedingly well. So both the things happen in the stock market. Therefore, return is not something. Ultimately, in the longer term, every generates same return.
Yes.
Whether it is Aditya mutual fund, HDFC or Prudential or any mutual managers will give in the long term more or less similar return, because everyone wants to actually generate return. Therefore, they will have course correction.
Correct.
It's only a question of time. But definitely you should keep in mind the promoters of the funds, people behind. See, the biggest assets in the mutual fund industry is actually the commitment of the promoter, shareholders. What is their vision? Yeah. His vision is actually just coming and then making, build the business and then move away. Or I am going to here for next 20-25 years kind of things. People, processes, and those are some of the things you cannot see it by yourself. Yeah. But that comes on the basis of the people around in the running the businesses. That comes is second. Third, of course, is the product. The product offering, anything that promises very high, I am different, and therefore I will be able to generate high return. So different is always not long-term sustainable. Different can always be only certain, because everything can be copied. Yeah. So I may be different today. The moment somebody hears me, they will go and actually replicate whatever I am saying. Quite possible. Yeah. Therefore, the advantage of uniqueness, saying I am different, therefore I will always remain different, on the basis of which we go and make an exposure, then the high probability you will also feel equally with the disappointment. So that's something I think one should keep in mind.
But from an investor point of view, how frequently should I revisit my portfolio? If the particular fund is not doing well, is it like a time for me to switch out that fund, or should I wait? I mean, what should I do when I see my funds are not doing so well?
Frequently, one should not review frequently. Yeah. Because you are not investing for 3 months or 6 months, you are investing for long term. Yeah. But once in a year, you have to review your portfolio just to see whatever assumption on which you have made the investment, whether it actually fulfills your aspirations, fulfills your needs, or are you in the right direction to fulfill your future dreams, for which you have to do review your portfolio. I'm not saying you should not review. You must review your portfolio. The reviewing not necessarily has to be backed by an action. You don't need to sporadically take an action, move from here to there, and so on and so forth. But while making investments, there's a high probability we would have made mistakes. Everyone makes mistakes. We would have made a mistakes of, say, thinking that I'm putting money in equity, or I would have chosen a wrong scheme. That's one possibility. Sometimes I would have felt investing in a diversified equity fund instead of I would have gone and actually put money in a thematic fund which will have a volatility which will be higher than the broad market. So when you make this kind of investment, these investments have to be course corrected. And that's something one should keep in mind. Core portfolio versus satellite portfolio. So sometimes you would have put all your portfolio from a core to the satellite. Then you have to do a course correction. You would have put extraordinary amount of money in a core portfolio versus satellite. You have to do the course corrections. Sometimes fixed income market gives a substantial higher return. Then can you ignore it from a power of compounding point of view. Therefore, the balancing of portfolio should be done, but need not be necessarily that, okay, somebody has not performed well, therefore you move out and then chase return. Only the mistake that you should not do, when selling a fund at when the performance is the weakest, need not necessarily always the right decision, because you have to also give some benefit of doubt to the money manager that he will put the extra effort to things through, see to it, he comes back on performance, he'll put the extra effort. Therefore, we must give some amount of time. After giving time, if it still doesn't work out, then you can actually make a course correction of the portfolio. So but at the same time, we should also keep in mind, chasing a return many times can actually put you in a disappointment.
So basically, you're just trying to say, review of the portfolio does not mean that try to identify those bad performers and weed out. Look at it holistically from your journey point of view. If there's some course correction needed, do those corrections.
Correct.
I think today SIP is considered as one of the great tool for solving most of the problems what we see. Market volatility, wealth creation, achieving different financial goals and so on. Is there any other way as an investor I can create wealth? That also leads to the debate of SIP versus lump sum. Which one is better kind of a debate? Where do you stand on that?
See, there is nothing wrong in making lumpy investment versus SIP. It all depends on what is the time horizon of your money. I think SIP is definitely helps you market volatility. I think SIP invest in higher price, lower price, higher price, lower price. You keep on investing at a regular interval. That is one. Second is SIP takes away your money without you telling them. You don't need to even plan it. You just give a standing instruction, every month account get debited. So therefore that gives you the benefit of before you even decide to stop it, the account is debited, right? That is the way investment should always be made. And then the third is you sign up for SIP for say perpetual. You sign up for say 20 years, 30 years. And then you are mentally prepared that I'm making the investment for long term. When you make a lump sum investment, you will start debating, today should I invest today, should I invest tomorrow, or should I invest in this fund? All this question comes. Whereas SIP actually takes away all these questions. You choose 3 funds, then put in all the 3 same lump sum. You put in say liquid fund and then do an STP. Over a period of 2 weeks or 3 weeks or 1 month also is okay. But you don't need to worry, no, if I don't put money today, market will run tomorrow. Market always run, always falls. Therefore, you don't need to worry about if you don't put money today. The herd mentality types.
Correct.
Housewife or mother or father of a family, when we go and build for the future of the education, my mother has done it for myself. She used to put recurring deposits. Therefore, the recurring in nature is actually quite powerful. That's why I think SIP is the way of investing. Is the best way to invest. It's only to remove your anxiety in the market. Because everybody is quite anxiety in the market, right? When you make good investment, next day onwards you have to start saying how much your NAV has gone up.
Correct.
Actually, one of my brothers used to say every day, he used to tell me, hey, well, today the market is, why the NAV has come down? I would tell him, market has come down, therefore NAV has come down. So suddenly you say, my money has gone up. Actually, the market has gone up, my money has gone up. Therefore, this I think we have to just keep in mind.
You did mention that as India, we are fundamentally very strong. We're doing good and multiple factors and all that. What would be those sectors which would be driving India for next 10 to 15 years? Few of the sectors, if you can pick and let's say mention. I mean, not as a stock tip or anything. Fundamentally, you think these sectors would contribute to India's growth?
Hey, first and foremost, I will say our country itself. I think the world will look at India for the next 10, 15 years as not just a $3 trillion economy. It's about, say, 5 trillion economy, then become 10 trillion economy. I think world will look at India as a whole. So what is driving India? I think is definitely the huge amount of young population, consumptions, and spending pattern, lifestyle changing. So all these are the drivers. Second is whatever you may build, any amount of infrastructure to build in the country is not sufficient.
Yeah.
Because vehicle population is rising and people population is rising. Now aspiration of people actually now are wanting to buy more cars and so on and so forth. That means you need a better road, better transportations. That means investments in infrastructure, I think is going to remain large focus from a country point of view. So what does it mean for investment in infrastructure? It means allied sectors, right? Yeah. It provides employment, it provides, the cities are getting developed. Yeah. Therefore, the whole ecosystems related to the infrastructure sector, allied sector, we call it that. I think all of them, I think, should do well. And third, of course, is the, among the limited sector, I'm saying, like banking and financial sectors, finalizations. I think with the digital infrastructure coming in, one of the bigger themes for the next 15 years, I think nowhere in the world has happened. India has become the superpower when it comes to the question of financial market reforms, creating digital infrastructure. When I mean digital infrastructure, all these mobile phones that we use, digital infrastructure. Yeah. And sitting in this room, I'm sure many of you would have transferred money to your Google Pay somewhere here and there. Banking and financial sectors will remain one of the bigger sectors. I always feel that banking and financial sector is a proxy to the economy. If the economy does well, banking and financial sector should do well. See, the manufacturing sectors, my personal belief is next 15, 20 years, I think we'll probably see a big boom. I think for two reasons. One is the China plus one, everybody says. Now everybody says we have to create alternate to China. We have to create alternate to China. Where do you go? You go to Taiwan, you go to Vietnam, and then you go to some other countries in Asia. Or US itself become a manufacturing hub and so on. Many things could happen. But definitely India is actually quite prominent in this space. We should look at how the ecosystem will get developed. Job, employment, prosperity, surroundings will get developed. So one of the areas where I think government has done a wonderful job, which is on the smart cities, is quite large, which can actually use it for improving the drainage systems, and better roads, better infrastructure, better bus stops, better buses, right? So all those things comes. So all these things means the whole ecosystem will be. That's why I said India. So I didn't want to restrict myself to only one sector.
Few sectors.
But these are the way I think we are maybe seeing very many moving parts. Like Make in India is one, Digital India is one, the startup culture is one, and all of them actually will ultimately lead to bigger growth.
Fantastic, sir. Thank you very much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.